Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets, and analyse the issues impacting the Kiwi economy. Let's get into it.
Kia ora koutou and welcome to the second episode of Markets, Mystics and Mayhem. This week we want to talk about the massive migration flows that we've seen in New Zealand over the last decade, and we'll talk a bit about what that means for the economy. And then an old Kiwi favourite, we'll talk a bit about housing and how the shortage of housing is getting worse in this country, not better. But we're going to start with you, MJ. We're going to talk about migration. I'm fascinated by the flows that we've seen. Please tell us what's happened.
Yeah, it has been fascinating to watch. It's kind of fun to remember the past few years by, a central theme. So obviously 2020 was the lockdown. But I'd say 2023, you'd probably crown that the year of migration because we saw monthly net inflows averaging 10,000, which is well above what we usually saw, pre-COVID. That was when we opened the borders after having been shut for such a long time, and people just came flooding back. So that was really quite aggressive, and we saw that annual net migration hit a high of 142,000. So again, that's a phenomenal rise and the highest on record. So that 2023 was really the year of migration. But now we're seeing that monthly net inflows have actually cooled quite considerably. We're now averaging under 4,000 a month. So that's cooled considerably. Arrivals have fallen, but it's really the rise in departures that has rapidly risen, and that's really what's driven the net inflow down to 67,000 on an annual basis. So we are seeing this sort of return to pre-COVID levels now. If we look at a sort of rolling 3-monthly basis of the net inflows, which we'd like to do, we'd like to slice up the data as much as we can. But when we look at that, again, it's going back to pre-COVID levels. So we've seen this rapid turnaround in just a matter of months.
So when you're sort of forecasting migration flows the best that you can, that seems to be a bit of a relative performance. So what's happening there?
What we like to look at is the labour markets of different countries, and we always compare ourselves to Australia because that's where we can kind of, it's hard to predict how people come to New Zealand, but we at least know how maybe people will leave. So we look at the relative performance of labour markets, and it looks like ours is deteriorating much faster and a much deeper deterioration than in Australia because their monetary policy hasn't been as aggressive as ours. So our economy is potentially slowing down much, much faster than Australia, which means they're probably, a much stronger labour market over there. So we could see some New Zealanders continue leaving in search of better opportunities abroad.
Australia is a pretty attractive place for Kiwis. I worked there for 16 years myself. I know firsthand, and when they had that mining boom, that sucked a lot of Kiwi workers across the Tasman, and we seem to be seeing it again now, right? There's just a better labour market, more jobs, better pay, and we see an outflow. It's not the first time, and it won't be the last.
No. It was unusual actually to see that we had a net inflow of New Zealanders during the pandemic, but we've now returned to a net outflow. I think there's New Zealand departures tallied something like 81,000 in the last year, which is again a record high amount, and that'll likely continue if we see our labour market deteriorate faster than in Australia.
So migration flows have been so large. I mean, from 2013 to 19, that was the largest migrant boom we've ever seen. And then, like you said, in the last year, we've had this massive inflow. What sort of migrants are we getting, and how much demand are they, I guess, creating in the economy?
Yeah, I'm going to steal your line here. I'm going to say that migrants have been the fountain of youth and employment. That's really what we've seen. They're in that sort of 20 to 30, early 40s kind of age group. So they're coming here, they're work ready, and they're keen to work. So that alone has helped our labour market because it's just added that more capacity at a time that it was needed. But yeah, with them comes more people, comes more demand, and we're seeing that in the housing space, particularly rental space. The rental market has been quite strong because of this increase in population driven by migration. So rental inflation has been quite high because people are in search of a place to live as they come here.
So they're young, they come here, they're keen to work, which is great. They're high participants, and because they're young, they're probably not buying a house. They're renting, right? So we've seen rent spike, which is interesting. There was concern that the surge in migration, like we've seen previous episodes, might be inflationary, but this doesn't seem to be the case.
No, I think this time around it's because our labour market has needed this. It's been more disinflationary, actually. The supply aspect of more people has helped our labour market. We were starved of workers when we had closed the borders, and actually having people come in had actually helped, wage growth fall because there are more people in search for a job. So that's actually been more disinflationary. But there are some inflationary aspects now with rental inflation still quite high. So that's quite unusual. Usually, net migration is inflationary, but what we've seen has been more of the disinflationary story. But there are still that rental side that's lingering. So
speaking of rents, probably talk a little bit about how that's influencing our housing market. So like we've seen, rents have picked up. They're running at the fastest pace in over 30 years. That's going to, I think, trigger investors back into the housing market. What we've seen is investors have been hunted by policymakers in recent years, but things are reversing. That rental yield aspect is becoming more attractive because the rents are rising while house prices are falling. So I think we'll see investors coming back as the housing market, I think, stabilises. And if our forecasts are right and house prices start rising into next year, we'll see investors coming back. And from a demand and supply point of view, when we look at the housing market, we've got to try and figure out what demand's doing. And as you say, we've had this massive migration boom, so that's putting pressure on the rental stock. And you look at the supply, because the housing market's been through a correction, residential construction is coming off. Consents, the number of dwellings being built is coming off at a time when we actually need it to ramp up. So when you talk about the Kiwi housing market, everyone talks about demand. Oh, there's more migrants here, there's investors, there's, first home buyers. But I don't care about that. What I care about is supply. So if we had a more elastic response from the supply, so if we could actually ramp up our supply when we see an increase in demand, we wouldn't have the affordability crisis that we have in the housing market. We wouldn't have people, being effectively locked out of the market because they can't afford it. So for me, whenever we talk about housing, it's supply. We need to think about ways of boosting supply, and that means stimulating investors into building rather than blaming everything on investors and hunting them down with bright line tests or removing interest deductibility, all these things that have been put on in recent years.
Overall, net migration is a net positive for the economy in the long run. It's just how well do we manage these big flows that can come that you just can't predict sometimes. It's just how well do we manage that. It's all an infrastructure story. We need to have the right infrastructure to be able to accommodate these extra people that come into the country, because it is a net positive in the long run. It's just how well do we manage them.
Yeah. And our infrastructure spending on a per head basis has been declining for how long?
A long time.
Decades, right? And this is going to be an intergenerational discussion, which I think we'll get into on another day, talking about the lack of infrastructure spending and how that's really, I think, restricting the productivity of this economy. This podcast is called Markets, Mystics and Mayhem. Mm-hmm. We've had two mystics talking, but we haven't discussed markets. So there's something missing.
Yeah.
What do we need?
I think we need to bring Menika in. She's one of our traders and she'll talk about markets. I think it's time to bring her in.
Okay, we're joined by Menika Pineski, an FX trader at the mighty Kiwibank. And what great timing. I mean, there has been so much going on in currencies. Really keen to get some insights from someone who lives and breathes and trades Kiwi every day. Menika, thanks for joining us today. I know you're busy. A lot of people won't know what an FX trader does. So can you tell us, what you do for the bank?
So generally I'm buying and selling currency throughout the day, mostly to cover Kiwibank's requirements as and when they deal with clients on the other side of that. So we have, portfolio of clients, importers and exporters that are buying and selling currency. And whenever that happens, it creates a risk for Kiwibank that needs to be cleared. So my job is to manage those risks and provide pricing for our dealers as well where required. So if they can't see a price on the screen early Monday morning, for example, they'll come to me. And otherwise, my job might also involve a little bit of proprietary trading from time to time as well, although that is a small part of Kiwibank's business.
They say Kiwi traders, or FX traders in particular, are, some of the best in the world because of how hard it is to trade Kiwi. Can you explain, how hard is it trading Kiwi?
It has been quite difficult of late. It can work out for you sometimes, but I mean, if we won all the time, then we probably wouldn't need to work. But yes, anecdotally of late, I've heard a few comments around the Kiwi currency and how difficult it is, in particular, to trade. For example, our FX tactical view sees the Kiwi heading back towards 57 cents. By the end of the year. That's still a possibility, but it's looking a little less likely at the moment, just as things pan out. And at the moment, Kiwi's, inexplicably to a point, a little bit higher than where we expect it to be.
Yeah, I mean, to be fair, the economy here has underperformed as we sort of thought. The Reserve Bank's come in and cut rates. Mm-hmm. So the move in rates markets globally, to me, makes a lot of sense. But, all currencies can't fall together. If we looked at what we thought was going to happen economically and then what was going to happen with the Kiwi, like you said, we would have been at 57 cents, but here we are at 62. So, why are we at 62?
Some of the drivers at the moment are particularly around the US dollar. So this week we're going to hear from the Federal Reserve, and they're broadly expected to cut rates and to kick off that long-awaited cycle of, having less restriction in their monetary policy settings. But a lot of the view is around, the US economy appears to be slowing down a little bit. The likelihood of them having that soft landing is starting to dry up a little bit, or at least it is in the minds of some market participants. So that's actually driving the US dollar a little bit lower. And I think that is probably one of the key drivers for the Kiwi not being as low as we expect it to be, especially given, the Reserve Bank of New Zealand cutting rates sooner than anyone anticipated, and also looking at the expectations from traders across the board around quite aggressive cuts from the Kiwi. We probably would have expected the Kiwi to reflect that a little bit more in its pricing, and it just hasn't. Basically, as everyone's looking to central banks across the world, we had the ECB cut rates again last week, and then everyone's also looking to the Bank of England, etc. So there's lots of moving parts. We've had a wee bit of a boost in commodity prices towards the end of last week as well, which tends to give the Kiwi a boost as well. So this week could be interesting though with the Fed. Yeah,
and I think the other currency that I'm kind of scratching my head about is the Kiwi-Aussie cross as well, because the Reserve Bank of New Zealand's cut rates, obviously, but it doesn't look like the Reserve Bank of Australia is going to cut rates until maybe next year. But the Kiwi's still holding up at pretty good levels. Again, you'd think that fundamentally that should be lower, but what's driving that divergence?
That's another head scratcher for sure. We have seen Kiwi Aussie pull back a little bit over the last week. So we had been kind of capped around 92.50 and we're sitting around 91.80 this morning, which is a bit of more of a reasonable level, but it's certainly a head scratcher. We've got a relatively hawkish RBA across the ditch, and they're quite adamant that they're going to be maintaining rates at their current restrictive levels for some time further. They're very concerned around the stickiness of inflation and the damage to the economy over time. So they're going to stick to their guns and keep rates restrictive, whereas the RBNZ appears to be, moving into a cutting cycle. How deep that cutting cycle is probably the main part of the story. But again, we're seeing a lot priced in, and the differentials don't quite weigh up for Kiwi Aussie as well. So we think it's a little bit overvalued.
Mm-hmm.
If I was an importer or an exporter, what would you be saying right now? I mean, what would you be telling your clients?
I would be telling them to probably keep in touch with their financial markets dealer on a regular basis, looking for any opportunities. So, for importers, I think, holding out for better rates may not work out in your favour given our projections. But in saying that, we're not really seeing those moves lower that we're expecting. So there's probably not a lot of hurry for them right now to go and book some more hedging. And for exporters, I would say have a look for any dips that we see in the Kiwi. There could be some opportunities in the short term. But our view is for a lower Kiwi. So technically they should probably wait till it happens. But like we've said, a lot of the Kiwi valuation is not what we'd expected. So you've got to be nimble. Keep in touch with your dealer and make sure that you've got some plans in place, put some orders in place if appropriate, and just keep an eye on it. It's a moving picture, really.
Absolutely. Well, that was great. Thank you very much for joining us, and we'll obviously get you back on. Again, it's great to have those insights from someone who actually lives and breathes currency. So yeah, thanks for your time, Menaka.
Thank you for having me, and I'll talk to you again. We'll see what happens this week with the Fed.
Yeah, awesome. Well, there you have it. Great to have Menaka on the podcast. Kiwi for me is always fascinating. The way the currency moves is it's really volatile, really aggressive, and can catch a lot of people out. So talking to your bank is a pretty good strategy.
Yeah, it's going to be interesting as always, we're watching currency markets with all central banks moving. We also forgot about talking about the Bank of Japan moving in the other direction.
Yeah.
It's another thing to watch this year. So yeah, interesting things developing in currency, and it's always hard to get it right all the time, but that's just currency markets.
Nature of the beast. That's it for another week. Thanks for tuning in, and we'll speak to you again next week.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.